Today, we're going to do a deep dive into property swapping and show you how using the departing primary guideline can help you get started as a real estate investor and use it as a smart strategy to increase your portfolio with low interest rates, low down payments. So we're going to walk through a real life case study, a client that we recently helped, and show you exactly how this strategy helped them. In fact, this is one of my favorite strategies. It's how I got started in real estate investing and built my initial property portfolio. And so I'm a big believer in the property swapping strategy. Okay, so first we're going to look at the current loan that our borrower had. So they purchased a house back in 2021 when rates were really low. You can see they had a rate of 2.962. They had a loan amount of 344. They put 20% down on a single family purchase of 430. Their payment includes taxes and insurance, so it's escrowed. Their total monthly payment on this property is currently $1,785. When you use the departing primary strategy, you've got a current home with favorable terms on it, and you want to keep those terms and turn it into an investment property. That way you get a strong cash flow. And then you go out and you purchase another primary residence that you're going to move into, and that allows you to get the best rate and the lowest down payment on the next purchase. So this works really well with people that don't have a lot of cash on hand, or people that want to have a great cash flowing scenario and keep the asset that they have now, which is their low rate first mortgage on their current home. Now, we always run a property analysis to get started to say, okay, where are we at with this house now? And so we did that for this borrower, and their property has now increased in value. We pegged it right between 460, 475. We're going to call it 465. It's a 4-bedroom, 2-bath, single family house. And this is saying that the rents on it are averaging, there's a range, it's giving us $2,915, but we're going to peg it at $3,000. Another way that we develop rents, and I like to look at multiple different comps to try and figure out what a property may rent for. So the next thing we looked at was realtor.com, and we looked at 4-bedroom, 2-bath homes in the area that were very similar in size, and we can see that the $3,000 is very reasonable for our rent estimate on this property. And then finally, I always like to go and look at the Section 8 rentals and see what Section 8 would pay for a tenant to come in there. And right now, this is the link right here if you ever want to go check it out. They have all the rents for every county in the entire country and all the historical data. They tend to go up every year. But right now, this is 2024, and a 4-bedroom's renting at $3,127 or $3,125. So $3,000 a month in rent is a very conservative estimate. Now, some of the key aspects of a departing primary. One thing you have to know is, and before you can close on that next purchase, you have to have a signed lease and a security deposit and first month's rent deposited in the bank account. So you do truly have to have a tenant lined up for your house. You're going to put your house up for rent while you're out looking at new homes. You're going to go under contract, and you're going to have a new tenant and lease in place. They don't have to have moved in, but you have to have collected the rents and have a lease in place prior to getting a clear to close from underwriting. Another thing you need to know about this is you're going to have a strong cash flow scenario, and you're going to see that here for this particular borrower, but you can't use that cash flow to help qualify for the next purchase. You can only use the rent to offset the current mortgage on your current primary. And so when you go buy your next primary, you have to traditionally qualify with debt to income ratio and whatever your other income is. But the rent on the departing primary, you cannot use to qualify in that DTI. Now, the good news is, once you execute this strategy for the first time, you're now a real estate investor, you're growing your property portfolio, and it's only up from there. Now, we talked about this earlier where we said oftentimes you're low on funds, you maybe don't have 20% to put down on an investment property to get into real estate investing, and so a primary lets you put the least amount of money down. Most people that execute this strategy, they're cash poor and equity rich. And so we look at tapping into your current home's equity so that you can use that as the down payment and to cover closing costs and that kind of thing on the next purchase. Now, in this particular scenario, the value of the house was $465. They had a loan amount of $321 on it. And if we pulled out $51,000 in equity, we would still be at 80% LTV. What that does is get them ideal terms on a second lien. You can go up to 90% on a second lien, but in this case, they don't need to. Now, we went out and we got them a home equity line of credit. Now, why did we get a home equity line of credit? That's because, one, we think at this point in the market cycle, we were high on rate. The home equity line of credit functions like a credit card. It's like having a revolving line. The rate does vary every single month, but you get flexible terms. You get interest-only payments, keeps your cash flow strong. It also allows you not to use the whole thing, to pay it back, to use it. It's a great tool. In this case, we took out a $50,000 HELOC, keeping us under that 80% LTV, and we had an 8.75% interest rate. For an interest-only payment for the first year, it's $4,375 divided by 12 gives us $365 a month. So now this would give them a first mortgage of $1,785, a second mortgage of $365, and a total payment of $2,150. When compared to the $3,000 rent estimate, we're looking at a cash flow of about $850 a month. Pretty strong for an investment property in today's market. Now, we had to go out and get a new primary for this borrower. And so they went out and they found a bigger home. They found a 5-bedroom, 2.5-bath, beautiful home in the same area for $555. This property, total escrow account, was $511. And we'll show you how that factors in just a minute. They're only putting 5% into this property, and they're going to be able to pick up a bigger home for their family. Now, we went and priced this in the marketplace. They had a 727 credit score. We're just going to call it 720. We dropped in the zip code. It's a conventional loan. We're using 95 for LTV because it's only 5% down. Notice this down payment is $27,750, but we already calculated a payment for the entire $50,000 on that HELOC. You would cut that payment in half if you only use half that HELOC. But maybe they want to do some rehab to the property. Maybe they have some other things to cover. So it gives you flexibility. Now, we went and priced this out, and I don't know if anybody's ever pulled the curtain back and shown you the full spread of rates and what rates really look like, but we love to do that because we're very transparent at the Colorado Mortgage Team. I couldn't fit the full spread here, but you get the idea. We can go from 4.25 all the way up into the 8s on this product, and we're targeting par. Par is the rate at any given moment in time that has no cost, no credit associated with it, or as close to zero as possible. In this case, it's an exact rate at 7.604, and you can see right here it has 0. Now, this is points on the front end of this, and you can see it goes up as we go down in rate, and you can see this is the cost associated. Now, 1 point is equal to 1% of the loan amount. Now, this is expressed as discount points on your closing disclosure. Now, as you go higher in rate, you would get a credit associated with it. So if we took 7.625, you'd get a credit of 207.61. You could use that towards closing costs. Now, one of the things we were able to do for this borrower is we were able to get seller concessions. And so we executed a 2-1 buy down strategy for them. And what that did is keep their payment down even more for the first couple of years. We anticipate there's going to be a great opportunity to refinance in the next few years because we're in the beginning of a Fed cycle. When we executed this loan for this borrower, we took advantage of the 2-1 buy down strategy. The rate was bought down from 7.604 to 5.604 the first year, and then 6.604 the second year. Now, one of the things that I really like about the 2-1 buy down is when it's funded, all that money goes into a holding account, like a savings account. It's really a trust account, and it supplements the interest each month during the 2-1 buy down. If you refinance out of it early, you don't lose the money. Whatever's left in that account becomes a principal reduction, because at the end of the day, when you're looking at this, your rate is always 7.604. It's just in year one, that 2% lower in interest rate is being subsidized by the money paid up front over that 2-year period. So whatever you don't use when you refinance, you don't lose it. It becomes a principal reduction. So that's a pretty nice flexibility and allows you to get more value out of the seller, because right now there's a lot of flexibility in the marketplace where people can negotiate things. So even though rates are high today, there's so much flexibility in the marketplace that you can take advantage of that you won't be able to take advantage of when rates come down and they're lower. That won't be in the marketplace, but what will be is refinancing to a lower rate. This borrower was able to get $13,000 in seller concessions, covered the entire cost of their buy down, even gave them a little bit towards closing costs. Now, here's how their payments break down. In year one, their payment starts at $35.39. We back out the $850 in cash flow from the rental. Their total payment out of pocket for the 2 houses is $26.90. Year two, it steps up to $30.30. We do a custom mortgage analysis with each one of our clients. And that's where we show you all the numbers in charts and graphs and side by side. And so I just took a couple screenshots so that you can kind of see what that looks like. So this borrower, their current home was worth $465. They had a $321 loan amount. They had a 2.962% interest rate, and a 1785 payment. When we combine that with the home equity line of credit, all of a sudden their loan amount jumps by 50,000. Their blended rate goes up, but it's only 3.697 as the blended rate. So still a very, very low interest rate with a total payment of 2150. The new home that they purchased, 555, 5% down, that 7.604, had a nice payment of 4235, pretty high. However, we brought that payment down through the 2-1 buy down. So that first year, that interest rate drops to 5.604, dropping the payment to 3539. This is before we put any cash flow into it. And then we take the combined real estate holdings. So now they've got $1,020,000 in value in real estate between the two houses, a loan amount of $898, a blended overall rate of 5.03, and a total payment of $2688. That's after we factor in both payments together and the rent coming out. And so now, instead of having one house, they have two. And what does it cost them after we make all these adjustments? Well, it's costing them $903 more a month to have the two mortgages minus the rent. Their total monthly payment is $903 higher for them to, one, have a much bigger house for their family, and two, have two properties and be a real estate investor. Now we're going to look at this another way. It breaks down the payments for taxes and insurance and mortgage insurance, and you see how it all comes together. Their total payment is $1,785 currently. Once they combine it and they have both properties minus that $3,000 in rent, they're at $2,688. Now their net worth. All right, now if they had just kept the current primary and never moved, they stayed in that smaller house for their family, right? They weren't into real estate investing. They just stayed where they were. Their current house would continue to go up in value. And we're using a 4% appreciation rate on this in a year. So their current house would have gone up. They'd have $352,000 in equity in that property. The two houses together, they'd have $552,000 in equity. Now, how did we get there? Well, their current house went up to 611. They've paid their loan down a little further, and so they've got that 352. You can see we're using a property appreciation rate of 4% a year. It's not always 4%. Sometimes it's higher. This could look a lot better, but we're just trying to be really conservative, show you the power of wealth building with real estate. So remember, we were looking at $1,020,000. Well, now we're looking at $1,342,000 in value in the real estate, and then the loans have been paid down. Right? We're making our payments every month. The tenants are paying us. They're paying our loans down. So now your loan balance is only $790,000 on both of these houses combined, giving you the combined equity of $552,367. I'm Clinton Sistrunk, your mortgage engineer with the Colorado Mortgage Team, and we are always here to help you thrive financially through real estate. So if you have any questions at all, or if you'd like to look at what this might look like for your specific situation in your specific house, we'd be happy to put the numbers together, put together one of these custom mortgage analysis, and show you exactly what that looks like. So please take a moment, write down our information, reach out to me and my team. We'd be happy to go to work for you, and I hope I get a chance to show you the true power that this strategy could have for your real estate investing goals. Have a fantastic day.